So, emergency meeting, almost an emergency broadcast. It's myself, Dan. We're with Ian's joined us as well, and we're with a very experienced Dom to try and shed some light on what is going on. And what we mean by this is the mortgage market at the moment, and everything is changing so rapidly.
I didn't have hair before last Friday, so
There's the grenade on the table.
yeah. Spot the bloke with shell shock.
Yeah,
yeah.
you look a bit stressed.
Yeah. It's. I've been in financial services now since 1987, right? So I've seen a lot. So I suppose first thing to say, the world isn't ending. This isn't unprecedented. We're the financial crash in 2008. The circumstances there were entirely different. That was structural. It was to do with liquidity. That's not the issue at hand. But unfortunately, the mini budget, which they're desperately trying to call something else, a fiscal event and all sorts of things, has disrupted the market, and lenders are very uncomfortable with how they're pricing their products, and that's really what's at the root of this. But I'll let you guys probably lead me in terms of what you want me to talk about, really.
Yeah, I worked in 2007 in property, going into 2008, and everything feels totally different to what it is now. I think before, everything ran away with us and there was no controlling what was going on because we were just in a total global crisis, whereas this seems to be a bit more, although that was man-made, this seems to be a bit more man-made and fixable for the right, if people do the right things.
Yeah.
It's just going to come down to a bit of ego in the political world and whether people are prepared to do the right thing, I think.
It's a very strange situation to find yourself in where we knew inflation was a problem. So the Bank of England have had their foot on the brake for 7 months now. This started back in January, or actually just before it was Christmas, wasn't it? The first time that they started to nudge the rate up. So we knew inflation was a problem. So the bank's had its foot on the brake, and the government have been sort of doing their thing. And then we have this change of leadership and a new chancellor, and it's that chancellor has come in and basically told the markets that he's going to put his foot on the accelerator and try and push, reduce taxes, put money in people's pockets. Well, the two things just look a bit weird. It just doesn't make sense. And the markets have effectively responded to say, well, you're asking us to borrow money on top of already stated aims of things like the energy price cap, for example, that's mooted to cost X billion, and they don't like it, and so it's therefore causing ripples in the market. The pound's gone down. And essentially, the problem that we've got with lenders is it's not they don't want to lend. They can't price their fixed rate products effectively because it's based on interbank lending, offered rates, swap rates, if it is the actual term. I'm not going to get into the definition of swap rates, but effectively is the rate at which you transact a variable loan to a fixed rate. And they can't price it effectively, which is why they've pulled out the market. It's not that they're out the market forever, and I think the media have got a lot of responsibility here. Bad news sells, but certainly last night it was a big thing on Channel 4 News. Everybody's leading on it. Oh, all these lenders are pulling out the market. You can't get a mortgage. Well, I'm happy to say you can get a mortgage today. There's plenty of solutions on the market. They're not as cheap as they were, but we've got to accept that the freakish days of incredibly low rates are over. They were never going to last forever. There's pressure on the interest rate now being driven by this budgetary announcement that is unnecessary in my view. Hopefully there'll be some sort of retraction. In the interim, we've just got to try and make the best of it. And I think it's obviously created worry in a lot of people's minds, certainly people that are buying, but certainly people that have mortgages that are coming to the end of their fixed term in the next 12 months. They're also worried.
That's the worry, isn't it, Dan?
I was going to say, it's a lot of people that are coming up with that. They've had the low rates and bought, a couple of years ago, maybe spent a bit more on those houses because the market was pushing the values up, and then suddenly they got a remortgage.
Yeah.
And what's the difference going to be between their current mortgage rate and the new one?
Yeah.
And then media is really scary, isn't it? Because you can't turn it on without something negative, but also different. I hear different things. Someone's saying mortgage rates are going to go up to 5%. Some are saying 7%. Some are saying 6%. What? I can't give an answer to it, but
what I do know about forecasts is financial forecasts are almost universally wrong.
Yeah, they were wrong 12 months ago. They were wrong 12 months before that. And they were wrong 12 months before that.
This banding around of 6% isn't helpful because different organisations that assess financial risk or futures or what, they're all going to come to different conclusions. What's the media do? It grabs onto the worst one and then it extrapolates it up. So if you think about the process of assessing affordability for a mortgage, the loan to income cap has always been there, and it's been there since the financial crash in 2008. And the affordability stress test, which was removed on the 1st of August, but everybody who's got a fixed rate mortgage coming to the end of its term will have been stress tested on the bank's variable rate plus 3%. So most people would have been stressed at 7% plus anyway.
Mm-hmm.
Okay.
So I think my take on this is, and it's using the benefit of being in the game a long time, certainly in financial services terms. Don't panic and stay calm. Don't knee jerk, because actually we don't know what it's going to do. There could be a change in the wind tomorrow. They could row back on this fiscal event last Friday, which would then all of a sudden the markets will settle down. It will take the heat out of it. The war in Ukraine could end,
Yep.
right? There's a load of different moving parts. So you have to kind of, in the same way as when markets are going down from an investment perspective, the last thing you do is human nature. Oh, I need to get out. Well, you're going to crystallize your loss. In the same way with debt, don't move too early, because you don't know where you're going to be. If it's fine to explore remortgaging now and paying an early repayment charge, if you can calculate and demonstrate it's in your best interest to do so. But don't rush into it without assessing whether it's the right thing to do or not, because you might spend a few £1,000s now and actually be no better off over the long term.
I suppose that sits what you said about, is that what the lenders are doing then a little bit? They pulled from the market to assess where they need to try and price it out because they can't figure it out. So if they don't know, how can anyone else know, I suppose?
Yeah, that's all it is. Some of it is also driven by demand. So HSBC switched their products off yesterday mid-afternoon. I was saying to Ian earlier, we were in the middle of applying for one, and they took the products off the shelf. Most unlike them, right? And it wasn't because they were repricing overnight. They have a limited amount of capital available per day.
Yeah.
And it was, we were in a queuing system I didn't want to buy tickets for Glastonbury. I wanted to book a mortgage rate. This
was very similar to stamp duty level, where you guys are on the phone at 7 o'clock trying to get through to HSBC because they had these unbelievable, I think it was when they were offering the 90%, and they were the only lender doing the 90%, weren't they?
Yeah.
And as a result, everyone's on the phone 7 o'clock in the morning, but they had a quota, and when that quota was gone, it was gone.
Yeah. Yeah. They only allocate a certain amount of capital per day, and then that's done. So they came back online this morning, and they announced that a reprice this afternoon that's coming in tomorrow. So they are, where possible, trying to support that. There's no doubt. They are trying to get their pricing right. No lender on the planet is going to lend on a loan that's not going to make money. I mean, that's how they make money.
Mm-hmm.
That's why they're there.
Yeah. So why on earth would a lender commit to a loan on which it's not going to make any money? The fairest way to treat borrowers is to make sure you're certain what your margin is, and are therefore confident you can stand behind that rate.
Mm-hmm.
So, they're as much a victim of this as anybody else. But it makes everybody stressed out. It's causing a lot of demand.
I think people don't quite understand that, and when you say the banks are the victim, they probably would throw something at the camera.
Maybe a bad word.
I totally know what you mean, though. But I think it's important to just explain in layman's terms that those swap rates, in simplicity, it's almost like the banks are getting finance for money to lend you finance for money, and if the rate is 4% and they're offering you a deal at 3.5%, well, they're losing 0.5%.
Correct.
And at the moment, they don't know what those rates are going to be next week, so they don't want to offer everyone 5% rates and then find that that's 6% next week, and they're out of pocket. So they want to lend money, they just don't know where to put the pin in terms of pricing.
And this volatility is unusual.
Mm-hmm. Yeah.
And that's the problem. The volatility is unusual. They've been lending money for as long as I can remember, and they'll be lending money long after I've dead. But the volatility is the problem, and that's why they're having to take a step back to decide what it is. Now they're coming back to the market, and it's numbers that nobody wants to look at. But They're commercial entities. They're going to lend at a rate that allows them to make money.
I suppose the numbers will come back in will have a bit of risk element for them as well, won't it? Until they know. So
Yeah, I mean,
yeah,
what we really need is a bit of sanity to come back into the market, which is a bit of certainty. The markets need certainty about what the government's doing. I think waiting until 23rd of November is too long to come out with this detailed fiscal plan in the Office of Budget Responsibility view. Um, the Once we do get some stabilisation and the lenders have got more certainty over the swap rates and where their margins are, we'll start to see competition. But essentially, at the moment it's like a zero-sum game.
Yeah.
Whoever's at the top of the league table is going to get very nervous because they're going to get bombarded, and then they'll say, "Right, we need to reprice now, or we need to just pull everything, get it off the table."
I think it's important to mention that for sellers as well, Dan, because as you explain that with the banks, it's very much the same with the properties. And when we're talking demand and supply, overnight, effectively, the property market has gone from a seller's market to a buyer's market. And I think it's really important if people want to move, they will still move. If people want to move or need to move, it will still happen. There just might be less volume. But what we probably will see is properties not selling within the first 2 hours. It might be the first 2 months, 6 weeks, 4 weeks. So it might take a little bit longer, which means buyers have more choice. And I remember all three of us would say 12 months ago, we would speak to one of our sellers or a buyer, and they would say, I'm looking up to 500 grand. A week later, they called us back. I can't find anything at 500 grand. I'm approved up to 570 now.
Yeah.
Week later, called us back. I'm up to 6. What have you got at 620? So people were pushing themselves out of uncomfortability. They won't have to do that now. So they won't spend the extra 100K. They'll do what's affordable, and the selection will be there to find. So it will be normalised. It just feels on the media panic stations. I mean, I watched the news last night, and I could not put a news channel on that wasn't a Labour MP. I mean, how structurally, catastrophic was that for the public to be watching Labour destroy the Conservatives on the news? That was all that was on the news. And that just doesn't help anyone, because it's like a child playground argument, and no one wants to hear that and see that. Whether you like Labour or Conservative, the other party is going to slaughter the other party's decisions. So we just got to calm it down, realise there's a bit of normality coming, wait for the decisions, and carry on as normal, as the English like to do, with a cup of tea.
Well, that's it. Yeah, I think you hit the nail on the head with people selling. People are still need to move and want to move. There's still buyers. We're still speaking to buyers right now that are booking in viewings, want to see houses.
Yeah.
People are just maybe on a side of caution a little bit for the next month, work out where their finances are, everything else. But I don't think it's going to change too much in terms of the amount of people wanting to move. Just the offers they might be making and how soon they're making them.
Yeah, I bought a house in 2008, and the mortgage that I had a 75% loan to value, was 6.05. And I didn't know any different at the time. That's what I bought the house at. And if I'd have bought the house a year before, I'd have had a £300 a month mortgage. Turned out I had a £750 mortgage. And then it changed back round, and house prices went up and the rate came down, and I sold and moved on, and it was normal.
I call it, it's the ups and downs of property ownership. You some days rates will be in your favour, sometimes they won't. But you can't ever time it. It's not in your control. The only thing that is in your control, and this is what we're encouraging all of our clients and people that aren't clients of ours, if you've got a fixed rate mortgage come to the end of its term, in the next 12 months, you need to know exactly when that switch over date from fixed to standard variable is. When you know what that date is, move forward 7 months. Start the process 7 months out, because you can secure potentially a new offer with that incumbent lender on a product transfer, because a lot of them have changed it from 90 days to 6 months.
Oh, really?
Or if there's a demonstrably better deal in the market, you can remortgage to another lender, get an offer that's valid for 6 months, and then just let your existing deal run out and then complete on the new one when your current deal's expired.
Really good tips.
This is not, nobody's used to this, because the environment's been so benign. It's been a case on all my sourcing systems. I have to choose a reason why someone's seeking to remortgage, and unless it's home improvements or debt consolidation, whatever, the standalone secure a better rate. Well, that's no longer applies. It's like it should be secure a new fixed rate, but that's what we've become used to. And there's a generation of borrowers, much younger than me, who have only ever known rock bottom interest rates, and that's why I think it's such a it's such a shock to the system that all of a sudden this really benign economic environment where the interest rate just trundles along on the bottom is now gone.
Do you think people that are this time next year going to come out of their fixed term, do you think it would be advisable for them to be overpaying slightly on their mortgage, try and get the loan down, or do you think it's probably not going to make much of a difference?
I mean, everything's loan to value based. You know that. So the lower the loan to value, the better deal you'll get. I think the trouble at the moment, because of these structural problems around pricing, the difference is quite small between 60, 65, 70. We used to see much bigger spreads. But of course, the less capital you owe, the less interest you're paying, the faster you'll have it gone. So our recommendation as financial advisors is always, if you have the wherewithal, take advantage of the 10% overpayment facility, because you're going to save thousands over the lifetime of your borrowing.
Mm-hmm.
Not everybody has that bandwidth. They're spread very thin. But you get somebody that's on, in some sort of sales role with good bonus. Potentially they can, take advantage of it.
I was going to ask about, so there'll be people watching this that will be going through mortgages right now.
Yeah.
Or have been applying for mortgages, or very recently buying everything else. Is there any risk that rates can change whilst they're doing that before they've got maybe their offer? Or
Yeah,
because I think that's something to maybe talk about, because there will be people out there that will be worried.
When you have a market like this where pricing is very difficult and lenders are constantly assessing their own margins, they're assessing where they are in the sourcing tables, the rate of reprice has just become very, very fast. And again, it reflects the underlying environment of rates and everything else. So in the old days, you've heard me say this before, in the old days, and I mean January, we could do a bit of research, hand it to the client and say, this is our recommendation. The best product for you is this.
Yeah.
There's the illustration. Have a good read. Have a good think about it. Let's have a chat. So they could sit there and have a cup of coffee in a couple of days and look at it and that sort of stuff. Now it's, if you want to secure this deal, we need to do it now. Not tomorrow, not tonight, now.
Now, yeah.
And it's just to avoid disappointment. So, we have banged on, you, me and Neil, for as long as we've been doing this stuff about preparation. Mm-hmm. Even I've changed my process now. I used to be a little bit more relaxed about how much of the documentation I saw before we went for decision in principle. We now ask for everything. Give us everything so that if we need to move fast, we've got everything. We're not waiting for you to upload bank statements, that sort of thing. Those are important to our process, but they're kind of ancillary to the lender, right? Give us everything now, because if we need to move fast, we've got it. We can't afford to sit here and wait for you to get your PDFs uploaded and we tell them, no, that's not acceptable. That's a transaction report. We need the full statement. We haven't got time for any of that. Give us everything now. We might need to refresh things if it takes you a bit longer to find your property, but we've got to have everything now, because it's the only way that we can guarantee that when you need us to act, we'll be able to act fast enough to secure you the rate that we can see that's on offer.
Might be worth us putting a list together for people of what everything would be. So I bet there's a lot of people that don't realise how much there is. I now do, because going for my mortgage a few months ago, there was a lot of hoops to jump through, which is fine. But there's a lot of information, isn't it?
Yeah.
I think people just can't be complacent with the advice. I wrote a blog earlier on today, and the last thing that I said is, don't underestimate the value of your power team when you're moving. Your power team is your mortgage advisor, is your solicitor, is your estate agent, is your removal guy, because these people are going to be very, very important in this type of climate to give you the right advice and tell you what you need to hear, not what you want to hear. And that might mean you need to take an hour out of work to get this done, because much like you said, Nationwide, I think, changed all of their rates within 24 hours by 0.9 to 1.4 or something like that. That's a massive swing. In 24 hours, you could have been paying an extra 1% on your mortgage because you didn't get a pay slip to Dom.
Yeah.
That's crazy. So, you need to act now on these things.
Yeah.
And we're in an area, Dom, where we're fortunate that it's quite affluent, which does mean that house prices are quite high, but it does mean the average first-time buyer is not actually... They're actually normally fairly good ages. They're sort of early 30s, late 20s, because they've got the bank of mum and dad and things like that to help them.
Yeah.
What would you say to people that are looking to buy now around 25, 30 and 35 year terms? Because not everyone knows that and understands that, but that in an explanation from you, could be quite an easy way to just keep the monthly payments down a little bit if someone looked at a 35-year term instead of 25.
Yeah. Mortgage terms in general have been creeping up. The days of most people taking out a 20-year mortgage are long gone. It sort of crept towards 25 and it's crept towards 30. Now it's crept towards 35. But everything's based on individual circumstances. It's the one lever you can pull to make the monthly payment affordable. Now, for some people, I would argue that it's better to have a longer term so that you're contracted to pay a smaller monthly payment and take advantage of the 10% overpayment facility rather than say, no, I want a 25-year term, even though that's going to cost me an extra £500 a month, for example. I'm making these numbers up.
Yeah.
Well, you're contractually committed to making that payment.
Exactly.
Whereas if you push it out, you're only going to pay more interest if it runs for the whole term.
My understanding of that as well, just sorry to butt in, but those overpayments are off the bottom line, are they not? They're not, or they just still, it takes it off the way from the interest.
Takes it off the capital.
Yeah.
You actively reduce the capital.
That's exactly what me and you did with my one. So I did mine over a longer period. So I have the option to overpay. But
Correct.
if things are a bit more difficult, I'm not committed to paying more money that I can't afford.
Yeah.
And if you're worried about it, you can either do it monthly or you can do it annually. So if you're worried about committing to that, set up a separate savings pot.
Yeah.
Put the 10% into the thing. And then, at month 10, if you go, actually, I don't need that cash and I want to get it into the loan, chuck it straight in.
Yeah.
Everyone's a winner.
The thing that I would encourage anybody that's thinking about doing it, before you make a payment, ring the lender to check upon the basis upon which the 10% facility is allocated. For some of them, it's the outstanding amount of loan at the start of each loan year. So obviously, as you repay capital per annum, the amount you can pay reduces, the 10% reduces. Some of them, it's just the loan at outset. And that's quite chunky. As you pay it down, you can also make 10% of the original capital. That's quite unusual.
Yeah.
But just check, always check, because what you don't want to do is pay 10% plus a penny and trigger the early repayment charge.
Yeah, absolutely.
Oh, yeah, good point. Stay within your boundaries.
Just check, get the lender to tell you how much you can pay without triggering the early repayment charge, and then you're not going to step out of line.
So I think to summarise for everyone that's listening and watching, it is a bit crazy out there at the moment, but it's been made crazy by people, and people can bring it back to normal. And we're expecting that if people want to pick up the phone to any of us and ask a question, we're available, because it is an uncertain time for people, but we're not expecting anything like what 2007 and 8 was, which a lot of people keep quoting, and even the media keep quoting. So just stay in communication. I mean, Avocado, we're going to be live tomorrow night at 6:00. All of the pages are posting updates all the time. Obviously, you've been on the phone to people since yesterday morning, just popped out for air for a chat with us.
He hasn't slept in 48 hours.
Yeah. It's not been that bad. Yeah. But our network provide a lot of support to us. Obviously, that's one of the reasons that we're part of the network. But they're in contact directly with the lenders, so we're getting quite a lot of insight direct from them. It's not an unwillingness to lend, right? It's purely driven by the volatility. When that settles down, they will settle down. So it will get better. I feel like an old doctor sometimes. It will get better.
Yeah.
But at the moment, it's a bit volatile. People are naturally feeling uncomfortable. I understand that. I sympathise greatly, whether it's buyers, sellers, remortgagers, whatever it is. I do sympathise, but don't suffer in silence. Just ask for help. We don't bite. We've seen and heard everything before. We'll give you some good guidance, even if we don't make any money out of it. We would much rather see people succeed and be happy than sit and worry.
We're all part of the community, aren't we? We're all part of the local community. We're all happy to help, and that's what we're here for. So if anyone needs advice or they've got someone that's panicking, just put them in contact with any of us, and we're happy to help.
100%.
Yeah. The worst thing you can do in a financial sense is stick your head in the sand, because it's not going to get any better. Sometimes you need treatment. Yeah, but you may not know what that treatment is.
Yeah,
and that's why we're all here, to work it out and give you honest advice, aren't we? To tell you what it is.
There were a couple of things that, couple of examples of questions that have come up from clients in the last few days. Some of these are from people that have offers. Some of these offers are long standing and they're waiting to complete and on the cusp of completion. Dom, can the lender change the interest rate that's been secured? Now, the usual answer to that is no, they can't. It's very unlikely, certainly from amongst the high street banks, if they've made a commitment, or the building societies, if they've made a commitment, they've already done their calculations. They know what that tranche of money has cost them, and it will see it through. But some of these boutique lenders, these specialists that have to go and find funding, sometimes they will pull it. There was an example earlier in the week, and this is not a mainstream lender. It's a very, very heavy adverse. It's the lender of last resort. They basically cancelled a load of offers. They're very, very unusual, but it can happen.
Mm-hmm.
So it goes back to my point around lenders won't lend money if they're going to make a loss on it.
Of course.
But it's very unlikely. So my advice is if you're in that situation and you're worried, talk to your advisor. The offer that you've been given will show the terms upon which the lender can make changes. It's typically things that they're checking for that have a change in circumstance. So, if they do a late credit check and they see you've taken on like a 40 grand car loan that wasn't declared, or, it's material things that normally derail it. So I wouldn't worry about it, but if in doubt, ask, check the paperwork, ask the question. That's point number one. The other one was about product transfer. So I'm in a fixed rate deal. If I secure a new rate, does that mean I have to give up the good deal I've got to take the bad one? Well, the answer to that is also no, right? So your existing deal will peter out, and then the new one that's been offered will just start the day after. So you don't lose what you've already got, but you've acted as early as you can to secure the best rate you can in a rising market. And unfortunately, it's timing. Some people are going to, you can't time it. So sometimes you will exit, and if you'd exited a month before, you'd have been better off. But that's life.
That's the way it goes. Yeah. Just have to roll with the punches and keep our head up and keep focusing. And like you say, in the grand spectrum of things, it's not too crazy that the numbers we're talking about. It's just we've had it so good for a couple of years that now we just got to knuckle down and make sure that everyone's getting the right advice for their personal situation. I think really.
Yeah, 100%.
So give us a shout. So we head out.
Definitely.
Thanks, Dom. Thanks, Dan.
Cool.